For Trump to try to reindustrialize the United States, to change the basis of its economy, is in my mind similar in magnitude to what Nixon did, and therefore the consequences, the bumps on the road, are going to be major, even if we assume success.
Greetings and welcome to our Wealthion show. My name is Trey Reik of Bristol Gold Group, and we're here today with a legend in the metal space, Lobo Tiggre, founder and editor of a fascinating and popular newsletter titled The Independent Speculator. So Lobo, thanks for taking the time to visit with us today.
Thank you very much, Trey.
Mm-hmm. So since my name's Trey Reik, and Trey is a nickname for William III, which is a little bit more boring, I cannot resist asking, is Lobo Tiggre written on your birth certificate?
No, it is on my passport.
Uh-huh.
There's a long story there we won't get into, but yes, I've always been called Lobo since I was a little boy, and the rest is too long to get into. But I decided to harmonize my names, and here we are. And
well done.
Lobo Tiggre is such a strange-looking name that we used Louis James at Casey Research because it was more normal sounding, for a proper financial publication. But Doug Casey kept outing me on my real name, so if I'm trying to be transparent with people, I figured, to heck with it. I'll just use my real name.
Right. And if that had been your full birth certificate name, I was going to ask you for the middle name. But anyway, I love the name. It has great flair. And thanks for joining us. I thought we would start with a brief description of your firm and your newsletter. So how does your firm make money, and how do you make money for your clients?
Those are excellent questions. And I wonder when you ask those, how often you expect to get an honest answer. Because everybody's going to say, oh, of course, I make my money working for my clients. So, But here we are. Truth of the matter is, believe it or not, I take money only from my clients, from paying subscribers. I don't take any money from any issuers for anything. We don't do ad placements in the newsletter. I don't even let them buy me lunch when I go kick rocks on the project, if I can at all help it. Sometimes you're in a mine camp and the only thing there is Dunkin' Donuts sandwiches that they have, and it's not much you can do about it. But on the way there, I pay for my own airfare, my own hotels, the whole nine yards. So nobody can ever say, oh, yeah, of course you said nice things about them. They paid for you to go on a junket to Tahiti or something, right? So it's a very simple subscription model. I have a free weekly newsletter, which if anybody subscribes to, it's called Speculator's Digest. You may or may not like my way of thinking and my opinions. If we talk about silver, that'll give you maybe a reason to hate me. But I can promise that I won't spam you. I hate that. You get one email per week and that's it. My paid services are twofold. One is, as you mentioned, the Independent Speculator, it's the Brent Cook model. It's what I'm doing with my own money. My own portfolio is the core of that service. And it has an alert service and the whole, all the bells and whistles of a full service newsletter. The other one, called My Take, is more like Consumer Reports. There is a monthly letter, but that's not really the service. The service is a database, which currently tracks about 1,000 resource stocks. I have a team. Obviously, even I can't keep up with that many companies. But it's a frequently updated database that can be searched and sorted and sliced and diced to get shopping lists or sell lists, tax loss season lists, whatever you're interested in. And again, I'm fallible. I don't promise that I get everything right, but I do promise that I'm not for sale. And so if there's a company in there with a thumbs up, there's no amount of money they could pay me to get that. It's what me and my team determine with our due diligence is the appropriate, thumb up or thumb down. And so it's really sort of like, if you can't afford to hire a geologist to fly around the world and kick the rocks for you, then My Take is the next best thing, right? You can hire me and my team to be your due diligence guys.
So for someone who is a subscriber to the Independent Speculator, do you have a portfolio that you recommend, or do you go stock by stock?
There is a portfolio, but it is stock by stock. I mean, a truly great speculation. You've been in the business long enough to know this. You can't do this every month. It's not like this month I'm going to have a brilliant idea. Well, this one too. You'll end up compromising if you try to publish a brilliant idea every month. So I don't. And sometimes I think I've had as many as 4 new picks in 1 month, and I've gone as many as 4 months without any new picks because I won't compromise on what makes for a great idea. And the criteria is for the main portfolio is, would I invest myself? And I do. And I put screenshots of my confirms from the broker, and people can see what the fees were, Forex, anything else, all in costs, and the track record that I have on my website. It's not a theoretical or a model portfolio. It's not calculated on arbitrary, January 2nd to December 31 chunks. It's the actual track record of all of my completed trades, all of them since I started the Independent Speculator. And so, some people, they can't bend their minds around that. They want to see, a yearly result. So we have a report card like that. But I think the real track record is what I've actually done with my money. And currently that's running around 2/3 wins versus 1/3 losses. And the average gain is around 41%, if I recall correctly, something like that.
So this was all an introduction in establishing, in all of this work, what do you consider your area of expertise?
Natural resources writ large, though I have to say I'm much more of a metals and mining guy than an oil and gas guy. And I do have I have a team, I have backup, and I also have a network in the industry. So when I'm stumped on something or I haven't seen something before, I can still call Doug Casey and say, "Hey, Doug, what do you think of this?" Right? But he's busy. So I have other people, other contacts. Actually, Rick Rule has been extremely useful on the oil patch side. He spent a whole day once educating me, and I'll never be able to thank him enough. I don't know what his hourly rate would be, but I know I couldn't have afforded it. He just contributed to my education in that way. And so I don't claim to know everything, but I hope to have the integrity that when I run into something I'm not familiar with, I can and will hire. I mean, I've hired metallurgists before. I've hired engineers to look at something when I get stumped. But I have been doing this for 20 odd years. So, I've kicked a lot of rocks and I have a pretty good idea for what to look for.
In support of your limited staff comments, when I ran big money in the gold space, I used to get asked all the time, where's your staff? And it was small like yours. And I would point out at the time that we were big investors in Oyu Tolgoi and it was being built. And, I pointed out that sometimes building a mine is a file cabinet business. It's not about getting, on an earnings call 4 times a year. I mean, if you want to check in, well, we poured more concrete, the airport's done, the concentrator's coming. So I understand that when you follow a select group of companies over a long period, as you have, you get to know them pretty well.
And the people, I have a metaphorical little black book of people who've lied to me really, literally, like just flat out lied to me, or let's just say didn't run the business as advertised. And I never forget that.
100% know exactly what you mean. So now that we've established your area of expertise, I'm going to go the other direction. Having watched some of your, your recent presentations, while you're a self-proclaimed rock kicker, you're also a dabbler, I think, in macroeconomics. And you've developed sort of a thesis here recently, which you call the Trump shock. And I was just interested as a way to start for those who are interested in red pill truths, your development of Trump shock versus Trump session. So everybody always asks you this question, so let's just get it out of the way. How do you see that all unfolding?
Sure. Well, I always like to preface answers to questions like this by specifying that I am a rock kicker. I'm a due diligence guy. I'm not an economist. And I think sometimes that's an advantage because the profession of economics, they're all driven by these models. And it seems like they're always wrong because the models are always wrong. And they adjust their model with this little input and they get these crazy results. And it's like the weatherman. Just look out their freaking window. Look on Main Street and tell me the economy is fine, that sort of thing. So the Trump shock thing is obviously a play on Nixon shock. And that's deliberate because I think, watching him now, the mantra on the mainstream media is that you have to take Trump seriously, but you shouldn't take him literally. And there is a grain of truth in that. It's not knocking on Trump here. It's just, you know, at best, he's such a TV performer speaking to various audiences that it's difficult to square all the things he says with each other and what he's doing. And a lot of people just say, "Oh, it's all chaos." But if you look at what he's doing and what the executive orders call for, that the overall pattern in the actions is pretty consistent. And it's not really about tariffs or fairness in international trade. He, it seems to me, is really trying to change the basis of the United States economy. He's trying to reverse decades of history and stop the United States from being a so-called, consumer-driven economy or services economy, and make it an industrial economy again. Now he paints pictures of blue-collar workers, with their quality jobs, like back in the 50s or something. That's obviously never going to happen. These new factories are going to be full of robots. So, if you want to work at one of these new factories that's getting built, you better be studying robotics, not going to shop class to learn how to operate a drill press or something.
The lathe.
Yes. Oh, that was fun. Did you do that in shop class?
Absolutely.
I don't want to get distracted, but that was fun. At RPI, they had lathes that anybody could use for milling iron and steel, not just wood. You could go in there and make anything you wanted. Anyway, I love that stuff, but I wouldn't bank on that as a career. Certainly not with the robots coming down the pike and, robot factories, all this stuff. Even if the factory wasn't roboticized, if Optimus can hold a drill more steadily than you can, you're going to have a hard time competing with Optimus. And that we don't want to get down the AI rabbit hole. To answer your question, the point is, what Trump is trying to do is really big. It's not just about tariff fairness or international trade. And, the maybe most positive way of looking at this is if you look at what he's trying to do, this reindustrialization, it all seems to focus on what our friend Doomberg likes to call military adjacent industries. So you want to make tanks, you need auto industries. Obviously you can't depend on your greatest geopolitical adversary to make your military gear and kit. That makes no sense. So it looks like, my way of looking at this is it's not just an America first agenda. It's a fortress America first agenda. And if you look at it through that lens, is all the crazy things that you hear coming out of the White House, it actually all kind of makes sense. It all fits in this pattern. And it's worth, if you believe that, especially if you believe that conflict with China is inevitable, or maybe even, Putin reassembles the USSR and becomes a bigger threat in the future. If you believe these are real threats, then it kind of makes sense that you want to look at the trouble the Europeans are having now, because they kind of disarmed and disbanded their defense industries, and now they're scrambling to reassemble their capacity. You don't want to be in that boat when there's a shooting war right on your doorstep. Fortunately, we have oceans on either side, so we have a little bit of time here. But I think this is the real agenda. I don't know. I'm just a guy here, just a due diligence guy. But it seems to me that this is the real agenda, and this is huge. And if that's really what you're after, you're willing to take a fair amount of economic pain, because it's not really about, creating those old blue collar jobs of the 50s. It's about building Fortress America and protecting it for the next century. And now whether the public will go along with that is another question. And hence the Trump shot, because, this is going to put America, to change something so dramatically is a really big deal. And I think this goes back to, something as huge as Nixon shock. When Nixon took, nowadays people, younger generations don't even remember or know, but to sever the dollar from gold, if a young person looks at that, oh, the gold standard, that's archaic, it made sense. We have, digital gold now. So why did we even need that gold standard thing? That was ancient. But at the time, gold was money, and the dollar was only accepted and became the world reserve currency, the Bretton Woods Accord and all that stuff, because it was supposed to be as good as gold. And because you could, if you were a central bank from another country, you could redeem your dollars for gold. So it was really just a more convenient way of continuing the gold standard. So for Nixon to slam the gold window shut on that Nixon shock, it didn't just change the nature of the US economy, it changed the whole global economy. The whole world order changed.
Mm-hmm.
And you look at all these charts from inflation to money supply to all kinds of derivatives and things, and they all go nutso after 1971 when Nixon did this. And it just, anybody who cares to look can see the magnitude of Nixon shock.
Mm-hmm.
And here's the warning. Here's the red pill, right? If I'm right, if this is what Trump is trying to do, it's on that order. Like even the end of the Cold War and the peace dividend and the globalization, those are big changes, and they had, large economic impacts, but it was sort of continuing the existing trends. The peace dividend just turbocharged what was already happening. Whereas for Trump to try to reindustrialize the United States, to change the basis of its economy, is in my mind similar in magnitude to what Nixon did, and therefore the consequences, the bumps on the road, are going to be major, even if we assume success.
Mm-hmm. And I totally agree with you. And to add to that, I would point out that all of our friends on Wall Street and in the media who are horrified about what Trump has done so far are not the folks that he's appealing to. So the 10% of Americans who own 90% of stocks are a little bit upset. But that next 40% that own the 10% and then the 50% that don't own any are not upset. And I think that that's something that the media really still hasn't come to terms with yet.
And they vote. Like, the media keeps getting the polls wrong, and they keep underestimating Trump and
Right.
his appeal. And they will never say it after the lesson of Hillary. But I think that if you shot one of them with a truth beam or injected them with enough sodium pentothal, but not so much to put them to sleep,
Mm-hmm.
they would use that deplorable word. It's these unwashed deplorables out there that support Trump, and they can't think that actually the silent majority,
Mm-hmm.
even people who don't necessarily agree with Trump on many important things, the overall agenda is pro-business. It is in some ways Reagan-esque. Get the government off the little guy's back. You can keep more of your money. It is, unabashedly populist, and honestly, a lot of it is kind of more Democrat than Republican. There's things in that agenda, like price controlling pharmaceuticals. That's not a GOP idea.
Mm-hmm.
Fortunately, I'm a libertarian, so I can look at these things, I think, maybe a little more objective.
Yay.
So sometimes it's an advantage, you to be outside, the red or the blue.
Rick Rule has perfected the libertarian lane for 25 years, so it keeps you out of everybody's.
I understand that there's people in our audience who are Republicans and maybe even a few Democrats. That one guy over there. But so I'm not trying to offend anybody, but I do actually think this helps, and people like Doug, my old mentor Doug Casey, he's kind of reckless in some ways, and he's pretty adventurous. And I'm not sure that his whole career would have worked out so well if he hadn't been a libertarian. Because if he drank say the conservative GOP Kool-Aid and he just followed the masses, then maybe his recklessness would have resulted in train wrecks. But as a libertarian who was outside of that mindset and not having the blinders on of left or right, then it was a very creative force for him. That's my perception.
And I've been in public presentations where people have literally hissed at Doug on things he said about the military and stuff. So I'm very familiar with.
Were you at Freedom Fest and the one right after 9/11?
Oh my God! A lot of people got up and walked.
Oh, I was there. It was, and he stood there, and this is a big hall, like 1,000 people, and half of them get up and walk out. Hissing, hairy eyeball, the whole thing. I'll never forget this. He leans forward, he grabs a little glass of water, takes a sip, and says, "Good. I didn't think they were paying attention," and just keeps right on going. Anyway, I'm not trying to throw firebombs into the audience, but I'm making an argument here for independence. Independence of thought.
So backing up from the Trump thing, which I think you explained very well, one of the things that I haven't heard you talk about in public much is the Fed, and I'm a bit surprised that you don't have a Fed shtick. So I'm going to put you on the spot because I've spent a lot of time studying the Fed and what I consider to be their erosion of credibility all the way down to the 2000 120 billion of QE a month with GDP at 6 and CPI already going from 5 to 7 and unemployment all the way down from 4. I think that 21 will be, the worst year of Fed monetary policy in history when history looks back. They're totally, but I'm setting the stage. Do you have a Fed view?
I do. And maybe it's a little bit of recency bias here. Until Trump shock set in, the Fed was calling the shots. It was Fed, like as you and I are speaking, we just got PCE out. I don't know when this will go live, but as we're recording, right, we just got PCE out, and the market didn't even care.
It was right on target.
It was slightly lower, but
right.
But at the same time, we've got the courts slapping Trump's tariffs around, and that's really all Mr. Market is focused on right now. What I'm saying is 6 months ago or a year ago, that PCE print would have rocked the markets. We would have seen, easily a 300, 400, 500 point move in the Dow, and similar echoes in the S&P. And so what I'm saying is, you may be seeing me focus less on the Fed this year, because it seems to me that
let me make sure I understand. You're saying that the PCE was low, was tame, was under control. Is that what you're saying? It was 0.1 and 2 year over year.
There was a range of expectations from 0.1 to 0.2, and the annual number came in, I think, 0.1 less than the analyst consensus.
So your point is inflation is kind of under control. Is that your point, or am I putting words?
No, my point is that the market a year ago with an inflation beat, the Dow would have went up 500 or 1,000 points. Woohoo! Yay! Interest rates are gonna go down, and that's going to be great for us, right?
Mm-hmm. Got it.
And today it was a nothing burger, because we had the court slapping the Trump's tariffs down and then up again and sideways. Nobody knows what's going on.
Mm-hmm.
But so the bigger answer to your question is, of course, the Fed is important. Of course, monetary policy is extremely important. And my overall view is that Powell is probably going to go down as another Burns and not a Volcker, despite his greatest wishes.
Mm-hmm.
As low as inflation seems to be getting now, that could be the result of Trump shock rather than control of inflation. And to bring another friend in here, Lynn Alden, if you've ever interviewed her, you know that she focuses on her fiscal dominance thesis. And to be frank, I underestimated this. And basically, my layman's translation of Lynn's very erudite and history-backed and data-driven analysis of this is simply the money helicopters are still in the air.
Mm-hmm.
And I thought, after the insanity of the COVID lockdowns and all the stuff they did, pulling out the stops, I thought surely you couldn't keep that up. Right, the money helicopters would have to land after a while, some semblance of sanity, and then they'd be ready to go for the next one. But they never did. We've been running, trillion to multi-trillion-dollar deficits since the COVID lockdowns. It never stopped.
Mm-hmm.
The Biden administration tried to tell us we had the greatest economy ever, but somehow this justified wartime levels of deficit spending. Mm-hmm. And now Trump's trying to tell us we're having the best economy ever now in 100 days, but somehow we need a new budget with $6 trillion worth of spending or whatever it is, right? Mm-hmm. And no debt ceiling until after he's out of office. These things don't square.
Right.
But there's 2 points. One is, of course, the Fed matters. And at some point when they start reacting, and I think Mr. Market will remember how important monetary policy is. But don't forget, there's also fiscal policy. Mm-hmm. And there is no force in Washington, I think, that can prevent fiscal largesse. I mean, this is the GOP right now that's trying to ram through this multi-trillion-dollar spending package with promised cuts, in the next decade. Of course, they always spend now and promise to cut later, and it never happens. So this is highly inflationary. And this is why I think that, to answer your question, I think that Powell goes down as a Burns, because it's not entirely up to the Fed. It's not just the Trump shock, it's the fiscal policy, fiscal dominance as well. Mm-hmm. And I think their hand will be forced.
So this has been laying the groundwork, because I think we share this view. Do you think it is an exaggeration to say that we are on the cusp of a global monetary reset?
No, But it depends on what you mean by cusp, because I have
Mhm.
heard people argue that that's where we are
Mhm.
probably my entire career.
100%.
And
20 years I've been
certainly in
amazed that the
the aftermath of
dollar
the
standard
GFC.
system has
Yeah.
lasted. Excuse me for interrupting.
No, no, no.
Go ahead.
We're on the same page. I mean, I remember all too painfully sort of drinking the Kool-Aid on this after the GFC, and it was such a big blow up. It was hard to
Mhm.
believe they could paper this over or kick the can down the road.
Mhm.
And Doug and my seniors in the space, everybody thought this was it. The house of cards was coming down. It didn't.
But gold's acting different. And the other thing that you and I have been doing for 2 decades is waiting for gold to go up for the quote unquote right reasons. There are all these other reasons, CPI, Fed rate decisions, geopolitical shocks. While they're all important, I've always said those aren't the reasons that we put all this work in. So it sure seems like gold. Let me rephrase the question. Gold was up 27% last year, and through today, it's up another 26%. Are you surprised by how strongly gold is performing in the first half of this year?
No and yes. I mean, I have to say, I was nobody's more pleased than me to see the hockey stick last year. I
Uh huh.
had I had for 23, my highest confidence trade was actually the other yellow metal, uranium. That worked out really
Mm-hmm.
well. For
Mm-hmm.
24, it was gold, not uranium. That worked out really well. Uranium went into reverse, and we know what gold did.
Mm-hmm.
And I'm still a gold bull. All the reasons for gold to go up are still there.
Mm-hmm.
And I wouldn't say so much this time is different, but actually, if you pull back and look at the big picture, if you look using the government's own statistics at the purchasing power of the dollar, this long curve down since 1971, and you look at the gold dollar exchange rate, I think gold is money. So I really object to calling it the gold price. I call it the
Mm-hmm.
gold dollar exchange rate. It's a Forex question in my mind.
Mm-hmm.
And it is going the other way. If you look at gold versus the purchasing power of the dollar, even using CPI, it's a giant X over the last 70 years.
Mm-hmm.
Sorry, 50 years. And there's other measures. So if you look at the big picture, just look at M2, for example. If you plot M2, cumulative M2 and gold, the gold wiggles more, there's more volatility, but the lines, it's very clear that they're let me put it this way. The correlation is over 90% or zero point
Mm-hmm.
0.9 if you want to be precise.
Mm-hmm.
That's a very high correlation, and which
Mm-hmm.
reminds us of Professor Friedman's dictum, right? Of always and everywhere a monetary phenomenon.
Mm-hmm.
These things being the case, it seems to me that there's an argument for just don't fret the noise, the near-term noise, and the volatility. You do base your paper currency in anything real like gold or silver or even copper, right? It's going to go the other direction because you print more of the fake stuff, and it's going to take more of it to buy the real stuff. There's no
Mm-hmm.
surprise there. It's when you get into shorter term comparisons and then you get into trouble or hoping, what do I do this year? What's it going to do this year? The answer to your question is we got a hockey stick last year. To ask for another hockey stick this year was a big ask. So it's not that I was bearish. These big picture things that I'm talking about, it's all there. It's all bullish for gold. But we got that hockey stick last year. So, I'm bullish on gold, but I can't say it's dirt cheap.
Right.
And by the way, if you look at a gold chart adjusted for CPI, and I know that CPI is a CPI and all that stuff, but still, it's the number we have. If you adjust for CPI, the 1980 peak in gold is around 3,500 today.
Right.
So isn't it interesting that it hit that level and then
That
backed off?
it was 7 cents above 3,500 for 1 minute. So in the middle of the night, it wasn't exactly trading there for a week, but yes, it did touch it, and obviously excited a lot of algorithms because it was down, I think, $182 within the next 32
Yeah.
hours.
And,
So
and, and the good news on that, if you think about it, like you kiss an all-time high, like supposedly real all-time high, and you bounce off it. That's the sort of thing you would think would trigger just a lot of selling and
right.
stops and profit taking. Gold bugs, they're never going to sell. But these traders on Wall Street or the comics guys, they're not religious about gold. They're just looking to make a buck. And so some technical trigger sets
Mm-hmm.
in,
Mm-hmm.
whatever. The fact that it only dropped a couple percent,
Totally agree.
and
Totally
then
agree.
here we are months later, And we're holding, around 3,300, it drops to 32 and then it comes back up again. It was at 34 just last week.
Mm-hmm.
And here we are at 3,300 again. That's a fantastic number for the actual business of mining or exploring. The projects now, it used to be like a ridiculously optimistic price assumption to assume $2,000 gold.
Mm-hmm.
And now, it's actually, if you look at the 3-year trailing average, it's like 2,500 or something, which it's hard for me to accept that. In a feasibility study, 2,500 just sounds too high, but
Right.
that's $800 lower than we are now. So
Right.
for the actual business of mining the stuff and for, building a mine, the current range is fantastic.
I
If
mean,
gold gets
the
nothing
average
but
gold miner
consolidate,
still values reserves in the $1,400 to $1,700 range. It's
well, yeah,
incredible.
I think it's moved a little bit, but just as an example, Barrick's existing mines were
Mm-hmm.
built on a $1,200 to $1,300 assumption,
Mm-hmm.
and we were close to 3 times that.
Right. Right.
So, not that Barrick made that much money, but that's a whole nother question.
So we'll get to the miners in a minute. But backing up, I've heard you say recently that your 4 favorite metals are gold, silver, copper, and uranium. So after teasing you in a good-natured fashion that's pretty much 100% of the gold space, I was interested in, the metals space. Those are certainly the 4 that capture most of the imagination and attention. How would you rank the 4? I know that you originally said copper was your pick this year, and then copper did very well. It's come back a little bit. So how would you rank the 4?
It's still there. Gold has exceeded my expectations, but my reasons for picking copper over gold this year as my top bet for the year haven't
Mm-hmm.
changed. The money helicopters we were talking about before, Trump's agenda, again, the reindustrialization, the things he's doing, the nuclear energy, even he's embracing AI and the data centers, even the crypto aspect. That's all very bullish actually for copper and energy
Mm-hmm.
minerals.
Mm-hmm.
And data centers are like airports or hospitals. You need 24/7, always there, always on, abundant energy. And sorry, just windmills and batteries aren't going to cut it for something like that. And this isn't just me, libertarian anarchist who hates windmills. I do have a Don Quixote thing, and I think of it every time I see a windmill. But it's what's his face, the pasty faced kid from Facebook, um, the
It's
CEO.
Zuckerberg.
Yes, right. Sorry, I'm having a senior moment there. Even Zuckerberg and Microsoft and Oracle, they're all talking nuclear
Mm-hmm.
for these, because they get it. That if you have an engineering or technical background, reality matters, and you need baseload power. So I'm very bullish on uranium, and I was before the AI craze. That's the existing fleet needs more uranium, let alone everything else that's coming, the small modular reactors, whatever. But the uranium price did go up a lot, and there are mothballed mines being brought online now. There are new mines being built now. So we're in the process of finding out if high prices have cured high prices, or if it wasn't enough and they have to move higher still. That is being determined now. Like
So
I say,
this is your yes position. Do you want to elaborate on that a little?
okay, let me come back. I'm addressing the 4 horsemen here. So, I like
Right.
gold a lot, but it went up so much last year. It's hard for me to say, ooh, it has to keep going, right?
Mm-hmm.
I like copper a lot. But with the Trump turmoil, it's Dr. Copper responds to economic unease. So that's not an immediate one. But because of the money helicopters we were talking about before, this is all highly inflationary. Copper is necessary for basically everything. So I'm extremely bullish on copper, after the kerfuffle. So there's gold, there's copper, uranium I like a lot, but we are, as I say, in this space of seeing whether, high prices cure high prices or not. And then silver, which is still a monetary metal, but
Mm-hmm.
it does have very obviously, measurably, and sorry, people, silver bulls get upset with me sometimes, call me Darth Silver and all that stuff. But it clearly has a much larger industrial side than ever, and that weighs on it. There's times when you see it, it's just tracking copper and not gold. That happens. Now, the good news is that I'm bullish on copper and gold this year. So
Mm-hmm.
for me, that's a no-brainer. Of course, I like silver, but it does make me less in a hurry to rush out and buy any silver stocks today, because if gold is kind of trading sideways and copper is going down because of the next Trump shock, I suspect that silver will be under pressure until that clears up. Ultimately, I'm bullish on all four. And now the answer to your question you jumped in with, the win-win portfolio for me for this year is actually gold and uranium, the two yellow metals, because if things go bad and things get scary, and there's a flight to safety, safe haven assets and things like that, that clearly benefits gold. That might not be so great for uranium or any industrial minerals, depending on how that plays out. So but my gold will make me proud. My gold stocks will pay me. If it goes the other way, I'm wrong to worry about, the difficulties of getting Putin to the negotiation table or any of these other things that I worry about. And things calm down, and Trump's tax cuts and his deregulation just produces an immediate, not eventual, but an immediate boom in the US economy. Well, my copper will do great, but the uranium will go nuts. And maybe the gold, maybe people won't feel a need for safe havens so much. So maybe my gold stocks will underperform, but my uranium stocks, they should go through the roof.
Mm-hmm.
And my base case is actually for both of them to go up, both yellow metals, by the end of this year.
Mm-hmm.
But if I'm wrong one way or the other, then one will go up and it'll hedge me against losses on the other side. And I'd honestly, believe it or not, maybe gold bug likes gold isn't much of a headline, but I don't see a scenario. I'm looking at the possibilities in front of us. I don't see a scenario where uranium and gold go down. Like what would do that?
Mm-hmm.
What would make people feel calm and everything's great, so we don't need safe havens, but we don't need abundant baseload power either. I don't see that scenario. So I either make money on both, which is what I'm actually betting with my portfolio right now, or one of them hedges me against the other in case I'm wrong.
Got it. On the gold side, at your firm with your colleagues, do you engage in the exercise of trying to determine what gold's fair value may be at any point in time or in the future?
No.
Mm-hmm.
Those giant X charts or M2 and gold, the big picture is all I care for.
Okay.
The rest is, sorry, it's just at best an academic exercise, because it's
Mm-hmm.
it never has predictive power.
Mm-hmm. So then
Go ahead.
let's flip it around. How high, like when you mentioned earlier the M2 connection to gold, et cetera, and people talk about the Fed's balance sheet and the 25% cover clause. A skeptic would say, well, so what? What does that have to do with gold? How high do you have a target for gold?
I'm happy just to get the direction right. So
Okay.
I never give price targets. But as we mentioned, if you adjust for CPI, 3,500 was an all-time high. So that was potentially a resistance level.
Mm-hmm.
And that doesn't mean that that's where it should go. It means like if you believe in any technical analysis that if it breaks through that, sky's the limit. And if it bounces off that, that's maybe bad news. But that's CPI. If you use shadow stats, it's like twice that high. I don't even want to say the number out loud, right? But it's huge. And there are numbers. I forget which one we used. We were just playing with different types of inflation. And there was one number that a real all-time high was going to be over $12,000 an ounce. It's not a prediction. It's not a promise. Please don't put that in the clickbait headline. But there are ways of looking at adjusting gold for inflation that would call for that. And it's interesting that a 4-digit number like that coincides with math like you're talking about that some of these people have done. Like if you wanted to back all the dollars in existence with the gold allegedly at Fort Knox, it would take something north of $10,000 an ounce to do it. Right. So it's interesting that kind of aligns. And another interesting thing is there's talk out there, which somebody even asked Scott Bessent about this in an interview. And it's not just the auditing of Fort Knox, but Trump himself said, well, it'd be difficult to go back on a gold standard, but wouldn't that be great? For a president of the United States to even say that is pretty jaw-dropping. But the interesting idea here is that if you do allow gold to hit its real price,
Mm-hmm.
and then you revalue the gold reserves in the United States, you maybe don't completely fix the United States' balance sheet overnight, but you make it a whole lot stronger, just like that. So for all these decades, the central banks have been the enemy. The Fed has been the enemy of the gold bug, right? They're suppressing the price of gold. The government doesn't want people to know how worthless the fiat currency is, so they're suppressing the price of gold, all this stuff. We could actually be in a world where they want gold to go up so they can revalue the reserves. And then suddenly the balance sheet looks better. The US gets its AAA rating back again, and everybody lives happily ever after. Or at least, I'm not sure that they can do that. I still think there's too many people who don't want to admit how far the dollar has fallen. Because if you do that, you're admitting that a dollar is not 1/3000th of an ounce of a gold. It's 1/30,000th of an ounce of gold, or whatever it is, right? That's a huge admission. And I have a hard time thinking that the powers that be would really be okay with this. But it's an interesting thing that this is actually in public discourse now. This isn't a libertarian tinfoil hat theory. They're asking the Secretary of the Treasury about it. And he's saying, well, that's not my idea, but it's out there.
Mm-hmm. Interesting. So in the gold space, we've both spent a lot of time waiting for the beta to bullion of gold miners to catch up. And when you look back, it is amazing. In the first quarter of last year, the average gold price was $2,071. Second quarter, $2,338. Third quarter, $2,476. Fourth quarter, $2,660. First quarter of this year, $2,858. And April was $3,218. So aren't you a little surprised that we haven't started to see some of that earnings leverage, out the gazoo yet?
Yes and no. I mean, the past bull markets, and the only, I didn't own stocks in the 80s. Or in 1980, when gold hit that peak, I actually was long, but I was long silver, physical silver. I was a kid, and all my lawnmower money and babysitting money went into silver rounds, Morgan dollars, that sort of thing. But I was there for the run up to 2011 and the $1,900 peak there. And, so I saw the stocks deliver with leverage, and that they, as a group, have been underperforming this time around, so yeah, there's some surprise there. But as our friend Rick Rule likes to point out, during that same cycle, from $258 to $1,911 an ounce, somehow the mining industry as a whole managed to turn that into increased negative cash flow. And I actually charted this. There's a free article on the website called "Are Gold Stocks Broken?", which I did last year in 24, on this very topic. And I charted it. You can see how, the gold price goes like this and the margins go like that. And the free cash flow is just like, it takes, Rick likes to say, it takes real talent to take a 7-fold increase in your underlying commodity and turn that into, less cash. Like, how do you do that without trying? But the point, though, is that if that's your recency bias, that's the last big run up. So now we have this one. Well, why would anybody pile into the gold stocks if the last time they did that, like the actual miners, the business of mining gold, managed to drop the football? They fumble.
So your point is they have to show that they're not going to do that again, and then we're going to have a big catch up.
And we already have data on this trade, because if you probably know this as well as I, but last year, if you differentiated without naming names or throwing anybody under the bus, like if you look at the gold miners that are known for operational excellence, and you compare to them the ones that are, have nationalized mines or operating difficulties and so on. So the GDX roughly tracked gold last year, which is basically useless. Like if you're not going to have if you're not going to have leverage to the gold price, why bother with the mining stocks? There's less risk just buying the gold, right? So that's to track gold. That's not good enough. You need to more than track gold. If you looked at the better companies, they way outperformed even last year. So this whole thing of, the gold stocks aren't going anywhere, it's actually not true. As an average, sure, look at the GDX, looks that way. But if you look at the better companies, they did great. They did like 2x, 3x, and we're seeing that now. So I think, this is actual data telling us that, yes, investors will look at gold stocks when they actually start doing what they're supposed to do. And fortunately, we're seeing that now. Even last year's underperformers are doing better this year. Then the next question is, when does it trickle down to the juniors? We like to look for our 10 baggers, and these little juniors that pop. And they really, as a group, haven't been loved. But again, the people that have made world-class discoveries, they are getting love in the market. They're getting takeover offers. The people that have been building or have, development projects, or they're building, a high margin mine, same thing. Those stocks are getting rewarded, and they're getting taken over. So it seems to me that the answer to the question is just, Mr. Market is once bitten, twice shy on this, and he's being a little savvier this time around. So you got to do your due diligence. You can't just buy the ETF or buy the market. You need to be a stock picker in this market until proven otherwise.
You mentioned the GDX, and I'm sure we share the opinion that the GDX suffers a bit from what I call negative survivorship bias. So in most industries, if you buy the largest, highest quality names, you're in pretty good shape. But in gold mining, if you look at the top holdings of the GDX, and again, without naming names, except for Agnico, whoops, that slipped out. But if you look at some of the big names, they're facing the challenge of replacing reserves, and that leads to all sorts of behavior and decisions that, may not be ideal. So assuming we share that assumption, what part of the food chain is your newsletter focusing on now? Even though you've already said you're not super, super bullish about any sector, but if you're going to look at gold miners, where should investors focus?
There's two answers. One is a general strategy. I have my own version of a barbell strategy. And that is, I'll have a few of the blue chips, the best names, cream of the cream. But I don't just buy those all the time. If I own one, it's because it hit a cyclical low and I've owned it for a while. Those top names, and you mentioned some, we all know who they are, but those top names, if you buy them when gold is down, gold is unloved, the stocks are unloved, you can almost guarantee you'll make money. The market will turn at some point. Those stocks will go up. And you could do that repeatedly, wash, rinse, repeat. Like, buy whenever the market's at a cyclical low, take profits or sell when you get it highs, multi-years highs, and just keep doing that. But that alone could be a money-making portfolio. Kind of boring, and it takes a long time, but we reliable. So the safe end of my barbell is a few of the majors, and then the high risk, high alpha, looking for hockey sticks on the junior end is the other end of my barbell. And I combine these to try to have a more reasonable overall average result. As for on the junior end, that's the overall strategy. Like, what kinds of stocks I like. There's a couple of things I really like. The pre-production sweet spot. This is perhaps my claim to fame in this space. As far as I know, I'm the first one to do statistically robust analysis of this and come up with, actual numbers, and they're startling. So I like the pre-production sweet spot, but there's only a couple of those a year. I mean, it's not every year that a junior makes that transition from mining to production. And so there's
your pre-production sweet spot, just sort of looking at the Lassonde curve, is that after completion of the project, before commercial production, or a little earlier?
It's, Lassonde curves goes up in the discovery phase, goes down into the boring engineering phase, or the so-called orphan phase, and then it goes up to production. So it's that up to production is the pre-production sweet spot. Gotcha. I didn't invent that name. It was already there. But, the quick version of the story is, back in my Casey days, I asked Doug, well, I'm looking for ideas and where to invest. And I go, well, how much is the gain in that pre-production sweet spot? How sweet is it? And he says, well, everybody can see who's building a mine, so it's not much, maybe 20%, something like that, because everybody sees it. It's priced in. So, but he didn't know. So I got with my team, and we put together some numbers, and it wasn't 20%. The first number I got was well over 100%, like 140%. And I was like, no, that can't be right. So I sent them back, and we got more, and we got a couple dozen examples, and it was still over 100%. I showed it to Doug, and he couldn't believe it. But then, he looked at the examples and he remembered them all. And he's like, well, I guess that's right. So this was the beginning, and there's a lot. There's a free report on this on the website. If you go to the website, use a little magnifying glass and type PPSS for pre-production sweet spot, you can download that. But the key numbers are that the average gain from a construction decision to first pour or first plate or first production or whatever it is, averages about a double. Takes about 2 years, averages about a double, and 90% of the companies plus get there. Now, they don't all, 90% don't deliver doubles, but 90% get there. And the best stat that I love about this is that this works even in a bear market. Not all of them get there in a bear market, but the average gain from construction decision to first pour in a bear market is still about 25 or 30%. And it makes sense. If you think about it, you're spending money, literally pouring it into holes in the ground as you're diamond drilling and so on, to making money, getting it out of one big hole in the ground, the mine. That deserves a re-rate. You go from burning money to making money. Of course, there's a re-rate. So it makes perfect sense. But as far as I knew, nobody had ever actually done the math on this before. Doug couldn't believe it until we proved it to him. Then I showed it to Rick. And this is one of my favorite things. I showed it to Rick, and he went away, and he came back a few weeks later, and he said that he'd given it to his bright boys in the back room to kick around and see. And he said, we could find no flaw.
That's pretty upbeat from Rick.
For Rick, that was my feet weren't touching the ground for a week. So, sorry, you talked about what do I like buying. So when I can find a good PPSS play, I'm all over it. I love that. But there's just not many of them. There's something else I call success in progress, which is the early part of the Lassonde curve. It's not pre-discovery. Nobody knows who's going to make a discovery. Not Rick, not Doug, certainly not me. And the way to catch that is to have a whole bunch of stocks, right? A bunch of prospect generators, all that stuff, and maybe you'll get one of these. But that first part of the Lassonde curve, it's not just the discovery hole. It's not, nothing and then discovery hole and then boring engineering phase. There's a lot of work to do before you get in that boring engineering phase. You got to drill off a deposit. So between the discovery hole and that first 43101 resource or thereabouts, there's a lot of success in progress. Like when you've really got a real discovery, that first drill hole is followed up by another one, and you have a model like it's a vein. It goes like this, so we drill it this way, and you keep hitting. That's success in progress. It's not just a one-hit wonder or something. It's a model that has predictive value, and it delivers drill results. Yes, if you wait for that confirmation, the success for the first discovery to happen, the point is that's not the end of the Lassonde curve there, right? There's this whole success in progress phase from that discovery to that resource, where they just keep drilling and hitting it. Every press release is great. There's recent discoveries, an example in the Yukon. Everybody knows who I'm talking about, right? It just keeps going. It's a freaking Energizer bunny of drill results. And the market loves that. So if you don't have to predict the discovery, but if you can jump on that success in progress train wagon, you can make a lot of money. So ideas like that, I try very hard to look for things where the odds are in my favor.
So really appreciate all of that. And looking forward, I guess my last question would be for those who are contemplating subscribing to your newsletter, which I would encourage everyone to do. What would they find your current positioning is for the second half of 2025? Where should investors be looking for the balance of the year? And I know that's usually too short a time period to get you to focus on with a long treatise, but what are your thoughts?
It's consistent with what we've been talking about. My actual positioning right now is long gold, long uranium, smattering of silver, waiting to deploy into copper. I just don't think we're done with Trump shock yet. And I think we're going to get a better buying opportunity. And I'm building cash right now. And absolutely, come the day, the top of the shopping list will be copper.
Perfect. Well, Lobo, thank you so much for your time. I think there's a million things here for people to think about and react to. And to be honest with you, I threw away my question list when we were halfway through. So I have all sorts of other things I'd love to ask you, but we're going to have to give you a break and check back in 6 months or so.
Next time. Thank you very much, Trey.
Thank you, sir.